Welcome to the second quarter Grand Wealth and Dimensional Fund Advisors webcast. And we are joined today by Apollo from Dimensional Fund Advisors, and we are excited to talk about what happened in the markets in the first quarter, as well as what to kind of expect for the year going forward as the conversation continues about inflation, interest rates, and of course the elections coming up in November. If along the way you have any questions, please go ahead and use the Q&A feature at the bottom of your Zoom screen. You can submit questions and I will be watching for them, and if they come up, we will try and get to them, and if not, we will follow up with you afterwards. Apollo, thank you for joining us.
Hey,
Cal, it's scheduled for the day.
Thanks so much for the invitation to be here again, and I'm actually super excited. And again, it's good news to report, so it's a positive note for this quarterly review.
Yeah, the market certainly started off with a bang for the year, and why don't you just give us a recap of kind of what happened in the first quarter so far?
Yep. So to begin with, the theme of this is a quarterly performance review. So we wanted just to make sure that all of you on the Zoom understand exactly what happened and how it ties to your own individual performance. To begin with, your individual performance is likely going to vary from anything that you see on the news. So let's just start with that comment that what you see on the news when you listen about about the Dow Jones Industrial Average or the S&P 500 or the Nasdaq, all of these metrics are actually going to be quite different than what you experience in your own portfolio. And the reason for that is that when you have a diversified allocation, it turns out that part of the money is typically allocated to ownership in companies, which is what we call stocks, and that's what the stock market is really designed to do, is provide access to ownership in various companies. And there's a second track with your money, which doesn't have to do with ownership, but rather lending your money to corporations and governments, including the U.S. government. And those are called bonds. And that particular mix between stocks and bonds is probably the most important determination of the driver of performance in your own allocation. So to begin with, I'm going to start with just a very generic allocation, which is 60% in stocks in ownership, 40% in bonds. And again, it's not anything magical about this. It's something that typically is tossed out there as what's called a balanced portfolio. And the reason I start there is because most people who would have a balanced portfolio, about 60% stocks, 40% bonds, what they would see on their statements, again, these are rough numbers just to give you an idea rather than be overly precise. But for the first quarter of 2024, somebody who had about 60% in stocks, 40% in bonds, they would likely have seen something in the order of about 5%, just a little bit over 5% in a balanced allocation. So that's kind of the number. So why is it that's 5%? Well, the 60% allocated to stocks, when you look combined on all the stocks, not any one stock, but combined among all the stocks that one might have. Again, in very rough numbers, it would be about 8% up. So for a quarter, I think it's really, really good. And the bonds, which is a 40% in bonds, which typically don't pay as much as stocks, they still went up. There was a positive quarter, roughly at about 1%. So when you put 60% of the money at 8%, 40% at 1%, the blend of the two would get you to 5%. If you had more money allocated towards stocks, would be closer to 8%. If you had more money towards bonds, it would be closer to 1%. So that's what I'm saying. It's a really important determination what blend did you have, and if you want to know exactly what you have, I certainly encourage you to talk to Calvin. It's one of the most important decisions in investing, the mix between stocks and bonds, and it's very specific to your own needs, your own circumstances, and it's really based on the financial plan that was created for you. And there are a lot of factors that go into that allocation mix. But I want to start there because when somebody say, how do the markets do? It might be irrelevant if you have most of your money in bonds, because you're not as invested in the stock market. So I want to start there, Calvin, because I think that too often people are kind of focused on the stock market and what's in the news, and they forget that part of their money is invested in bonds. But the good news to report is that both for stocks and bonds, we did see positive outcomes for the first quarter. So and by the way, one of the things that I love is if you can put in some questions and we can have a bit of a dialogue, and I know Calvin's going to moderate and look for any questions and pose them to me, but please go ahead and use the Q&A button, which is on the 50-yard line of the Zoom window, and type it in the Q&A. It's only visible to Calvin, and he will certainly then ask it to me. So that's that. I want to start there because I think it's a really important consideration. If you don't see the numbers that are in the news, you didn't miss out. It's that a lot of it had to do with maybe the allocation between stocks and bonds. Bonds had positive returns, but not nearly as high as stocks. So I think that's a good place to start, just to kind of manage expectations.
Yeah, and it's important that we maybe just briefly touch on why we include bonds and a variety of stocks in a portfolio. It's really to decrease risk, right? And risk might be defined in just how much a portfolio's value goes up and down in any period of time. And really, as you mentioned, it's calculated to achieve a rate of return that helps to achieve someone's financial goals, which we can model out and plan for in a financial plan. And that's something that we do regularly with our clients, is update their financial plan to make sure that allocation is still correct for what they want to achieve.
Absolutely. And to your point, that's a great point. This is not a static thing. This changes across time, and it's very specific to where you are at that particular moment. But Calvin's absolutely right. Historically, what's happened is that bonds have not fluctuated in value nearly as much as stocks. So if you want to think just from a visual perspective, stocks tend to fluctuate something like this, ups and downs. It's a bit of a, it's a roller coaster.
A roller coaster.
And then, if you look at bonds, they still have a bit of a roller coaster, but it's more like Legoland. It's more like Disneyland or something. It's a lot tamer in the sense that they still fluctuate, but not nearly as much as stocks. And then just to give an idea, to kind of put some color to what Calvin was saying, if you look at bonds, for example, on a one-year basis, if you take any 12 months, probably the worst you would have seen in any 12 months would be maybe a fraction of the drop that you would see in the stock market. The worst stock market that we've seen is in the U.S. over the past 20 plus years or so. It's been about a 37% drop. Bonds didn't get anywhere close to that. So the point being here is that balance is really important, and it's well thought out. It changes across time, and it does protect you so you don't take the brunt of a market downturn when that happens. But let's look now at the 8%. So we talked about the stocks. So let's look specifically now at the stock portion, and why did we see this 8%? Where did this 8% come from? And if you look at the first quarter of 2024, in terms of the where the money came from and where the allocation came from, well, it turns out that for the first quarter in 2024, you had an 8% return, and the reason for that was because the U.S. portion of the allocation tends to be the greatest, and everybody has it differently. Calvin decides on that. But typically it's 60%, maybe more. And in the U.S., what we saw is that the U.S. stock market, again, these are rough numbers. These are very rough numbers. The S&P 500, for example, was up about 10%. So you had a really nice outcome in the U.S. It's about 10% up. But then the second largest portion in terms of stocks is countries like Germany and France and Japan, and those are called international developed. And those are also up, but they're up by a bit more modest, 5% or so, roughly speaking. Again, these are rough numbers. I don't want to get overly attached to this, just to give you a sense. And then the third categories are countries that are like Taiwan and Brazil and China that represent a smaller portion of the allocation, and those were up about 2.5%, so roughly half as much as international developed and about a quarter as much as the U.S. So it is interesting to see that stocks around the world did not move in tandem. And in fact, the U.S. had the best performance among the different groups, the international developed emerging. But Calvin, what's interesting is that when you think of international developed or emerging markets, those numbers, the 5%, which is still very good for a quarter, it reflects the underlying performance of the individual stock markets within that category. And what's fascinating is that if you look, for example, within international developed and you ask, well, how do these markets do on an individual basis? What's fascinating is that the best performer was actually did better than the U.S. And there was Ireland, and Ireland was up about 15.7%, so quite a bit higher than the U.S. for the quarter. And it was followed by the Netherlands, and the Netherlands was up a little bit less than that by about 15.5%. So we had international markets that did better than the U.S., even though as a whole it was 5%. So not every country did worse than the U.S. Some did better, but we did also have some laggards. And Hong Kong is one of them. It was up. It was actually down about 11% or so, or 12% or so. And then the worst performing among these international developed was Portugal, and that was down about 18%. So what's interesting here is that when you look at stock markets around the world, a lot of times they get condensed in this one number, the 5% for international developed. Well, it's a little more complicated than that, because when you look at individual stock markets, some did much better than the U.S. and some did worse than the U.S. So it wasn't uniform across the world. And now if you look at this last category, the emerging markets, and apply the same exercise, what you find is that the best performing stock market in the world happened to actually be an emerging market country, and it was Peru at 15.9%, so a little bit better than Ireland. And then right behind it, it was Turkey. And Turkey was up about 14.6%, despite all the economic challenges they have in that country. And at the lower end, we had Thailand, and Thailand was down about 8% or so. And what's really interesting is that the worst performing among these international emerging markets countries was Egypt. It's a very small portion of the portfolio, but that was down roughly about 30%. So a big drop. So once again, we see that around the world, stock markets did well, and you did diversified portfolio would have had Ireland and Peru, the best performing stock markets in the world, but also would have had Portugal and Egypt, which had much lower returns. And before I kind of wrap it up here, Calvin, this is a very interesting thing, because one can look at the Egyptian stock market and just say, what a disaster. Why are we even invested in Egypt to begin with? Because just this doesn't seem like anything good is going on there. What are they doing there? First of all, it's a very small portion of the portfolio, but there's something very interesting and in fact educational about what happened to Egypt this particular quarter. If you were an Egyptian investor and you used your paycheck in Egypt to go buy ownership in the Egyptian stocks, and let's say you bought the stock market in Egypt for the quarter, what's interesting is in the local currency, the Egyptian market was actually up about 7%. 7 or 8% or so, something like that, about 7% up for the quarter. So even though we see on our statements that boy, Egypt is down 30%, it turns out that the Egyptian market was actually up for the quarter. We just happened to see a negative 30% down. So how come? What's going on here? Why is it that a positive 7% translated into a negative 30% for U.S. investors? Why did that happen? Well, it turns out that by regulation in the U.S., when the performance of foreign stock markets are reported on your statements, something has to happen. When we buy Egyptian stocks, we have to take US dollars and convert into the Egyptian liras, I think they are. The opposite is also true. When we look and take the profits back to the US, we have to convert those earnings back into US dollars. So there has to be a conversion, an exchange between the local currency and the US dollar. And here's the fascinating part. Over the quarter, the US dollar has significantly strengthened against the Egyptian currency, which is really, really good news if you are a traveler. Because instead of getting 100 liras, you might be getting 150 liras. So that's a really good thing because I get more local currency to spend. The trouble is for an investor, it's exactly the opposite. When the US dollar strengthens, whatever profits you might have had there and you take them back home, they're going to become less. And over the reason that we see this negative 30% is, again, it's not because the local market did poorly, but because the US dollar got stronger. And the strength of the dollar has a negative impact on the performance that we see on our statements. And for folks who want to just intuitively I'm just going to use the intuition and just quickly. So let's just say that $1, and let's just use the yen because it's a well-known currency. You get about 100 yen, and that was a starting point. So if the company made, let's say, 1,000 yen in profits, then you would take home about $10. And that's kind of the starting point. But let's say that now the US dollar has strengthened. I'm just going to use some radical numbers you see here, so make it easy. And now instead of getting 100 yen for the same dollar, now the dollar is stronger, and let's say you get 200 yen. You get twice as many yens, which is really good if you travel. The trouble is that if the company makes the exact same profit of 1,000 yen, and you try to take it home now, well, you need to spend 200 yen to get $1, meaning that you only bring in home $5, even though the profits of the companies did not change. So the idea is that when the dollar strengthens, that's good when you travel. It's really not good as an investor. And that's exactly what we've seen this year. And in fact, Japan is another good example because in the Japanese yen, the stock market was up roughly about 20%, but we only saw 11% on our statements because the dollar got stronger. So I wanted to make sure that I covered that because it's a really important consideration. The performance of international market is not just what happened in the local market, but also is impacted sometimes quite tremendously by the exchange rate between the dollar and that foreign currency. And by the way, the last thing, the opposite is also true. If the dollar becomes weaker, then the results that we see on our statements are going to be higher than the local stock market.
Yeah, that's great perspective to provide, just because there are times where the dollar is weaker than international currencies. And so even though the dollar has been stronger in the last few years and some of that return maybe has been muted, there are times in history where it flips. And by maintaining a target allocation to international stocks or in emerging market stocks, we're able to help clients take advantage of those opportunities and maintain continued growth and a certain level of volatility without going outside of what is appropriate for them.
Absolutely. That's the key. Staying disciplined, because this is not something that the dollar always goes up. We've seen this throughout history. It goes up and there's a point where it might reverses. Nobody knows exactly, but over the years, it's been pretty much a zero-sum game. It's
Yep.
never been that consistently the US dollar keeps going bigger and bigger. No, no, no. It fluctuates. It's just that the cycle is not predictable.
Yeah. And some of these, you know, even just zooming back to the difference between the stock returns and bond returns, you know, when we're managing portfolios for clients, that can be a good opportunity for us to rebalance a portfolio. So stocks have done well really since the beginning of November last year and have had a really good run. And kind of that allowed us this past quarter to rebalance some portfolios by selling some stocks and buying some of the bonds that have not performed quite as
Absolutely.
well relative to the stocks, which helps us to maintain that discipline. You kind of go back to the old saying, sell high and buy low, and by having those target allocations and rebalancing to those allocations when required, allows us to maintain that discipline and continue sort of the smoother ride rather than this really volatile ride like you showed earlier.
Yeah. And that's such a great point, because this rebalancing that Calvin's talking about is a huge value added by the advisors, because it's hard to make these decisions in the moment. You have to be able to create a system and put a system in place where you take away the emotions. It's very systematic, and you decide what to do before things even happen. In other words, when an earthquake happens, it's not the right time to decide, what am I going to do now? How do I prepare? You need to be prepared in advance. But it's also interesting that Calvin, one quick note that I just had a conversation yesterday with a client who was asking me, okay, so the market's up about 10% this year. What does it mean for the rest of the year? Does it mean that
Yep.
the year is going to end up well or not, given all the things that are going on? So the first thing that I had to kind of make sure that folks know is that there's a lot going on in the world right now. You're hearing about the Fed, interest rates, there are elections coming up, there's still a war in Ukraine, another one in the Middle East. So there's a lot of uncertainty out there. And people want to know, well, how is this uncertainty going to impact the markets? And the answer is quite interesting. And I'm going to try to frame it in a way that's not confusing. And that is that nothing that is known today, all of these events that I just recited, nothing that I mentioned will impact the performance of the markets going forward. Nothing that is known today will impact the performance of the market tomorrow. Nothing. Because all of these events have an expected sort of impact on the performance of stocks. And if the expected impact is positive, well, those stocks have already moved up in value. If the expected impact is negative, the value of these stocks or reflects that, because the market participants are not some fools who are vacationing on some remote island. They showed up and like, well, the Fed's going to change rates. They know all of these things, and the market's job is to take all of these and incorporate them into the value of companies, and that happens every single second of the day. So nothing that you hear on the news it will impact the market for the rest of the year. The only things that will impact the market and will drive the performance of the market for the remainder of the year, the only things are something that is unknown at the current moment. Nothing that is known will impact the market. The only thing that will drive the market going forward are things that are unforeseen by definition today. So in that respect, if you're in December of 2019, and you're sitting at home trying to make a forecast about the market and what's going to happen in 2020 for the market, it would have been absolutely silly and foolish, because what drove the world in 2020 was the pandemic, which December of 2019, it was completely unforeseen. And how foolish it was to try to predict what the market's going to do, given that nobody had the idea of what the magnitude of the pandemic. 2022, who thought that the Russians would be foolish enough to invade another European country? And all of these events will be the drivers of the performance going forward. But just because the market is up this year, it's interesting to explore what does it actually mean? How often do we see that a market that's going up will result in the first quarter will result in a positive outcome for the year? So we did this exercise for the past 30 years or so, and this is what's so interesting. If you look within each year and you ask, well, at some point, was the market up and by how much? What's fascinating is that over the past 30 plus years, in every single year, even in 2008, there was a terrible year for the market. There was a moment in time when the market was up. And in 2008, that market at some point in 2008 was up over 20%. 20% up in a year when it ended up being down 37%. So it turns out that in every single year, there's a moment in time when the market goes up. Now, what's also fascinating is that if you look at the same years, there's a moment in time when the markets go down. There was a moment in time when the market had a very large decline. So in 2020, the market at some point was up as much as 20+%, and it was down over about 50% at some point. So every single year, what's fascinating is that there's not a single year when the market is continuously up at every point in time or continuously down. Every single year, there's a moment in time when the market can go up or can go down. But what does it mean when you look at the remaining of the year, when you look at the entire year? So now this is the largest gain and the largest decline within a year. And what does it tell us about where the year ends up? And the answer is, it doesn't really as much. Because you look at years when the market was up, like you look in 2002, the market was up at some point over 20%. It ended up being lower here. You look at every single year. I'm not sure that I read anything in terms of what's the market going to do in terms of ups or downs. The best that I can do is tell you that roughly, it's about a quarter of the time in any given year the market goes down, and about a quarter and 3/4 of the time in terms of years the market goes up. But there's nothing that within a year that tells us after the first quarter how is the year going to end up. It's completely unknown at this point.
Yeah, the one thing we do know is there will be some volatility. I think in my career, there's always a point in almost every year where stocks will fall from some relative peak of 5 to 10% below that peak, and that might they might be up 15% for the year and fall down to 10 or fall down to 5. But right, that doesn't mean that we know the market will finish up or finish down.
Yeah. But the good news, I think, and this is something that whether the market goes up or down, that has already been accounted for in your plan. So when the plan was created, Calvin and the team acknowledged there are going to be random times when the market's going to drop. So when they built the plan, they said, well, if you're going to need the money in the next year or two, perhaps we have to be a little more careful to consider what if we get one of those periods and not put as much money in the market. So even though the market might come, it might be unexpected in terms of the timing, but it has been considered as part of the plan. And I think this is huge because, again, we know these things happen, and if you can plan for the time when it happens, and I think the earthquake is a good example. You don't know when the earthquake's coming, but what you need to do is plan. And it's the people who never plan who get hurt. In my case, I built the house, the foundation, I tied the shelves to the wall, and might not be super pleasant when it comes, but it's not going to be devastating as for somebody who's never done it. He's like, what? I need to do something. You need to do something.
Right.
In advance.
We do have one question, and this might be a good lead into our next topic. But in the same fashion of how currency fluctuations can impact some of the returns from international stocks, do inflationary pressures affect returns for the stocks that we see?
That's a great question. So I'm so glad somebody asked it. The inflationary it could impact the market. And in fact, we've looked at this exact issue, like whether or not the inflation impacts the stocks and the bonds. Here's the thing. The inflationary pressures, they typically don't impact the market the way that most people think. Because the companies, inflation means that prices are going up across the board in the country. And what's interesting is that if you think about who are the beneficiaries of these price increases, not necessarily beneficiaries, but who is charging these higher prices, a lot of times these might be the companies that are part of the stock market. So if Coca-Cola is charging more, if McDonald's is charging more, if Starbucks is charging more, if you go and you pay more for your toothpaste, well, those additional revenues, they end up going to companies. So what's fascinating is that the companies actually, their revenues increase. And what's been really noted over the past few years is that these companies had to pay more, so they had to increase the prices because it cost them more to produce. But the research over the past few years, what it's shown is that the increase in prices that the companies actually passed on to consumers were actually quite a bit higher than what it cost them additionally to produce. So let's say that I sold something for $10 before, now it cost me about $12 to produce. Well, instead of raising the price from 10 to 12, they increased it to maybe 13 or $14. So this inflationary period actually almost like gave a license to some companies to increase prices, which they couldn't do for the longest time. But the supply chain issues. So in other words, inflation doesn't always impact the market in a negative way. And that's really important to know, because quite often you hear that inflation is going to devastate the market. Not at all. Who's charging more? The companies that are on the market. But what's interesting is that inflation could have a negative impact on the value of bonds. And that is a much greater impact. And the reason for that is that when investors agree to lend money, let's say to the U.S. government, and inflation is I expect it to be 1% or 2% over the next year or so. Well, I'm going to be okay if I get inflation at 2% plus a little bit more. So if I get 2.5% on my money, I'm kind of okay with that, because at least I overcome inflation. And that's what investors want to do, overcome inflation in bonds. And then on top of that, just a little bit for the fact that they're lending money. But when inflation goes up, instead of the interest rates kind of being at 2%, if inflation is at 4 or 5%, those interest rates go up. And that's exactly what's happened over the past 2 or 3 years, when interest rates on bonds have really increased. And a lot of it, in my opinion, has to do with the fact that inflation has moved up. And what it did, bonds were more negatively impacted by these increases in interest rates, because if you have a bond that pays 3%, the new ones pay 5%. Guess what? If I try to sell mine, I'm not going to get as much because the new ones pay more. So the impact of inflation is actually probably more significant to bonds than to stocks.
Yeah, and it kind of circles back to what we were talking about earlier about the efficiency of markets and the markets being able to incorporate all of this information that's known publicly in an instant. And so when there's inflation pressures, depending on what type of, maybe wages are going up, maybe there's a supply chain issue, but the market is able to price that into stocks. And as long as demand continues to be strong, as you said, the price increase unfortunately gets passed on to the consumer. But if you're a stock owner, you're sort of hedging against that impact on your budget by having potentially a equal or positive impact in your portfolio.
Absolutely.
Thank you for going through that. The next topic we wanted to just touch on briefly is just kind of in going forward the rest of this year, how does the Fed approach handling their interest rate policy in light of inflation and trying to continue to pursue reaching that 2% target of inflation that they are working towards.
Yeah, and we talked about interest rates and going up, and a lot of it has to do with inflation. And you mentioned the Fed. It's been in the headlines, and a lot of folks are wondering, well, why is the Fed increasing interest rates? Because if I'm a home buyer, it's much more expensive for me to buy. If I'm a business, it costs me more to borrow. I might not build as much. So it's hurting consumers, it's hurting businesses, homeowners. Why in the world is Fed doing what it's doing? And to really understand, I think it's really important, Calvin, to take a quick look at this. Why is the Fed doing what it's doing? To really understand this, we need to go back to the last time that we had high inflation in the U.S. And the last time that we had high inflation in the U.S. was in the early 70s. And I think what is going on right now, in my opinion, really has to do a lot with the lessons that we learned in the 70s from that period of inflation. So let's go back and rewind the tape to the early 1970s and what happened. And in my opinion, there are two major events that happened in the early 70s. And the first one had to do with the fact that in the 60s up until the early 70s, in order for the U.S. government to print a dollar bill, it had to have gold in the bank. And that reassured everybody that the value of the dollar is backed up by a precious metal. The dollar has value because it's backed up by a precious metal. And in the early 70s, economists pointed out that we're kind of running into a big problem. We are just not digging up enough gold to be able to print all the dollar bills that we need for the economy to function, because we had more people in society, the economy was growing tremendously, it was more productive, and we just didn't print enough dollar bills. And because of that, what's fascinating is that in August of 1971, President Nixon went on TV and he told the world that as of today, the US dollar is no longer tied to gold. And that was a shock to many people because they're afraid, boy, the government can now run the printing machines day and night. There's no backstop. The dollar's going to be worthless. And there's understandably a bit of a panic in society. And what President Nixon did in order to mitigate this and not just to have a huge impact on society, he basically ordered that you cannot increase wages if you're an employer, and you cannot increase prices. So what's called a wage and price freeze. And that was in August 1971. Because of that, the transition from the gold standard to the type of money we have today, which is fiat money. And by the way, since 1971, the U.S. dollar has not been backed by gold. It's just been freestanding, and it has value because we all believe it has value. But the interesting thing, Calvin, is that was supposed to be a 90-day wage and price freeze, but it really wasn't lifted until January of 1973. We're talking about a year and a half later. So you have a situation where for a year and a half, prices are not allowed to be determined by markets, by supply and demand. So you have this compressed valve, and then you release it, and at that point, you see that prices really shot up in the early 70s, in 73 or so. And just when this was happening, a second major event happened where the Organization of Petroleum Exporting Countries, they decided that they didn't like our policies in the Middle East. So they cut oil to the U.S. and we had a huge energy shock where we just did not have enough oil. And price of oil went from about a quarter and it quadrupled to about $1 a gallon. And not to mention the fact that you couldn't get it. So you had these things, and in early 70s, all of a sudden inflation starts taking off. And the Fed realizes that if we increase rates, well, consumers are going to spend less, they're going to buy less, businesses are going to spend less, they're going to build less, and that's going to reduce the price on the pressure on prices. And that's exactly what happened. They increased their interest rates, the demand went down, and then inflation started to cool. At the same time, when they did this, because consumers and businesses were buying less, the economic activity also slowed down. And when they saw that, they're like, whoa, just kidding. We don't want to mess with the economic activity. So they changed course and they cut rates. And at that point, they flip-flopped several times in the 70s. And by doing so, they sent a very clear signal to the markets that we are not serious about fighting inflation because we're also very concerned about the economic activity. And by flip-flopping, basically they create a really paradoxical but interesting situation. What they did is they created the expectation that inflation will stay high, that the Fed is not serious about fighting it, so I expect inflation to stay high. So if you're a union member in Michigan and you're negotiating a 5-year contract and you expect inflation to be 10% per year, well, you're going to bake in at least a 10% increase in wages for the next 5 years, which is going to keep the prices going up and up and up for the next 5 years. So in other words, the expectation of high inflation became a self-fulfilling prophecy. And that's really important to know because that was a huge mistake that the Fed made by flip-flopping. And in the late 70s, a new Fed chairman came along. His name was Paul Volcker. And he came along and he said, no more monkeying around, no more moving in and out of rates. We're going to stay with the high rates for as long as it takes for the inflation to come down, but also to reassure everybody that the Fed is 100% committed to fighting inflation. And he stayed with high rates. And what happened is the economic slowdown did happen in the early 80s. But once we got past that economic slowdown, Calvin, what we had were 40 years of price stability. And the reason we've had this incredible run of price stability is because everybody in society was convinced that should inflation come back, the Fed learned the lessons in the 70s, and you will not make the same mistakes. So if you look back at 2022 now, and you say, okay, inflation is going up 6, 7, 8, 9%, and the Fed is now confronted with that reality, what would you do if you're the Fed, given the experience of the 70s? Well, the obvious answer is that you would, stay with the increased rates. And how long would you increase rates? Until inflation is under control. And you also reassured everybody in society that you're not going to change course too early like they did in the 70s. And that's exactly what the Fed has been doing, has been staying with high rates because they don't want to repeat the mistakes of the 70s. And inflation is a greater evil than anything else because it becomes a self-fulfilling prophecy. And the Fed basically has said, if the inflation stays on this course down, because over the past year and a half or so, inflation has gone up from 5, 6, 7, 8 to about 7, 6, 5, 4. It's about 3% right now, which is the long-term average. And the Fed has said as long as the trend is down and we kind of go back to that desired 2%, we don't need to necessarily increase rates anymore. And that's what they've done, is just kind of stayed with the same rates. Well, on the other hand, they said, we're really going to cut rates depending on where the inflation goes. If inflation starts going back up again, perhaps we'll delay the cutting of the rates or maybe increase the rates. And if the inflation stays on the course down, then perhaps we'll cut the rates maybe 2 or 3 times this year. So what is going on right now? It's exactly in line with just what I expect, with what's intuitive. And it also gives us a sense that this year, what the Fed's going to do will depend, in my opinion, completely on inflation. If inflation goes up again, you're likely going to see fewer cuts in rates or maybe no cuts. If inflation continues to go down over the past, like it's been over the past year or so, then you will see what they suggested were like 2 or 3 cuts this year. At this point, it's unclear. I mean, over the past week or so, there have been headlines saying that inflation has come a little bit hotter, a little bit higher than we wanted to see it. So to me, what that signals is that I wouldn't be in a great rush to say rates are going to come down. It's just that we'll just have to see how inflation plays out. And to the point that he made it, Calvin, the information is already there. It's going to be the unforeseen events that are going to they're coming over the next week, 2, 3 months, 2 or 3, and that's what's going to drive the Fed's decision. But I'm 100% convinced in my personal opinion, that what the Fed did is in line with what every reasonable economist sort of suggested they should do. And I don't think there's anything that was unreasonable. In fact, if I was in their shoes, I would probably do the same thing. I would have done the same
Yeah,
thing.
yeah, it's important to set that tone of, inflation will come back down, and the economy then can know what to expect and plan for the future. Because without having some certainty in what to plan for, it does make it very challenging for companies, for individuals to make those plans.
And by the way, Cal, this is when I'll just quickly mention this is a really interesting fact that was pointed out in the Wall Street Journal the other day. Over the past year or two, inflation has been clearly on the way down from about 9% down to about 3% where it is today. Clearly on the way down. The data suggests that inflation is clearly contained and on the way to being where it was. But what's so fascinating is that in the surveys that the Wall Street Journal did, about 80% of the survey respondents believe that inflation is going up. In other words, the perception in society is radically different than the reality. People perceive inflation as going up. When you look at data, it's going down. So there's a huge disconnect right now between the perceptions in society and the data. And this is, to me, really something interesting because perceptions drive reality. And again, it's what we talked about earlier. Perceptions are also something that can drive inflation looking ahead. So there's another interesting twist to see how it plays out. But I do believe that's a fascinating part. 80% of the respondents believe that inflation is going up when the data suggests completely the opposite. And even the Wall Street Journal, I rarely see a front page article kind of like being shocked at the difference between the reality and the perception of the individuals in the survey.
Yeah, that is certainly an interesting thing to take note of. How we feel about the economy or certain aspects of the stock market performance is often different than what reality is. We do have a few more minutes left, and so I want to pivot to an interesting topic that is on the horizon this year in November, and that is the topic of elections and how the stock and bond markets perform in years we have elections and in the years to follow. So what should we expect in this year of a presidential election where two parties are fighting for control of the federal government?
Right. And I was just in D.C. A couple of weeks ago with my daughter visiting some colleges, and we got to see all the monuments, and you looked at all the history that goes there, and one of the comments that one of my friends who works in for the federal government was like, listen, every single election cycle, it's the most important election ever. And you kind of go back to the way back, and every single cycle is like, this is the most important election ever. And in this case, I'm not here to mention it's certainly a huge decision in the fall. But what's interesting is there's no but. What's interesting about this election is that it tends to be quite emotional. And I'm not here to kind of minimize the impact of the emotions, but rather to suggest that our job as investment managers is to be very pragmatic and not make decisions based on emotions and how we feel, but rather what does the data suggest. So when it comes to election years, and you asked about that, I've heard of enough investors kind of asking the question, well, it seems that this is throwing additional uncertainty in the market. The market's already dealing with so many other things. Now you toss in one more thing on top of that. It cannot be good to have this presidential election, and the market might not like it that much. So the question is, if you look at data, and we have good data in the U.S. stock market going back to 1926, almost 100 years of data, and you go back and you say, okay, let's look at the election years. And see what the market did and if there are any lessons that we can learn. It's quite fascinating because in this time span, we have had 24 different presidential elections. So 24 years out of these 90, almost 100 years, we had presidential elections. And the first thing that it obviously comes to mind is to examine in an election year, how often does the market go up versus down? Because if it is indeed true that the markets are becoming more uncertain because of this election, well, they ought to mean that perhaps the results of the market might be impacted. So when we ran this exercise and look at these specific years of election, and we sorted them based on positive and negative years, this is quite interesting because over the past 100 years or so, out of the 24 different presidential elections, 4 of them were negative years when the market went down. But what it means, Calvin, is that 20 out of the 24, the market went up. It was positive, which is quite remarkable because the overwhelming majority of the years, the market did go up. So being an election year, it doesn't seem to be overly concerning to investors. The majority of the years, the market's gone up. But there were years when the market did go down, and I wanted to see if there are any lessons that we can learn from the years when the market did go down in an election year. Even though there are only 4 years out of the 24, what is it that we can learn from that? And it was quite interesting because the first time that happened was in 1932, and we had Roosevelt versus Hoover, and we did have this negative return in the market. But what's interesting is that at the same time, we're also in the Great Depression. So one can say, well, yeah, we had an election, but we also had the Great Depression. What might have mattered more to the stock market? And then you fast forward about 8 years, and in 1940, we had the second time when the market drops in an election year. And again, we had the election, but that was really the true start of World War II. That's when all these countries are getting engaged in the war. So we had an election or the war. What might have mattered more? And it took 60 years until the next time that we saw a negative market return in an election year, and that was Bush versus Gore. Obviously, went all the way to the Supreme Court. And one can say, well, maybe the election might have waited on the market. But if you remember, 2000 was also the year when we started the beginning of the dot-com bust. All the companies like Pets.com and all the other stocks, technology stocks that actually started crashing. So yeah, we had the dot-com bust or the election, and the last time we had an election with a market downturn was in 2008. It just happened to be the great financial crisis that happened that particular year. So what's interesting, Calvin, is that if you look at the election, and you ask the question, well, being an election year, how scary is that for investor? The answer is the overwhelming majority of the years, the market actually goes up in an election year. And for the 4 years when it went down, there were significantly bigger events in the world than the election itself that might have caused the market to drop. So in that respect, again, and we don't look at the election right now and saying from a data perspective that somebody should make a move with their money because of being an election year. Not at all. It seems like the markets are not really as negatively impacted as one might believe.
Yeah, and that it's so interesting to, if you kind of look at the percentage of the number of years that go up versus the percentage of the number of years that go down, that's kind of in line with just any year that the stock market is going up or down. It's kind of about 3/4, maybe a little bit more of the years that the stock market goes up, and about 1/4, a little bit less, that the stock market ends up going down. So it really is, the markets recognize that the election can create uncertainty, but they're looking much further forward than the next year or 4 years or 8 years. And anticipating economic growth through an election cycle.
And that's a key insight that you brought in, Calvin. I mean, the markets are and you kind of touched on something that's so important. The markets are forward-looking in the sense that when you buy ownership into a company, you're going to have that ownership for years and years and years to come. And you know, back when I lived in Lansing, some of the folks might know there was downtown East Lansing. There was a Pinball Pete's right across the Marriott. And then above Pinball Pete's, there used to be this photo studio called Elbinger Labs. I don't know if Doug Elbinger is still around in Michigan somewhere. But the interesting thing is that it was one of the few labs that developed black and white film. And I used to that used to be one of my big hobbies as a kid. So I ended up working in the lab there and I loved it. And recently my daughter started shooting black and white film and it kind of triggered this analogy that if you look at the what's going on right now, in 2024, this is when we have the election year. So maybe this is people are saying, well, the election year matters. And for sure it matters. The thing is that this election year is a snapshot. It's a scene. It's a frame of what's going on right now, whereas the stock market, to the point that he made, it's a much longer running movie because if you own a piece of the company, you're going to actually own it for many, many years down the road. So what the market does, it values the ownership earnings that you're going to get for many, many, many years down the road, not just this year. So in that respect, there are companies that have been around for over 100 years. And if you think of how much does that one election year matters in the lifetime of General Mills, that's been around for over 100 years, or Exxon, or Eli Lilly, you have to put some perspective to this. This is one of the scene, it's one of the frames. But stock ownership, it's a very long-running movie, and I'm so glad that he brought that up because it is forward-looking for so many years down the road. And what happens this year, in the grand scheme, is not as meaningful as most people think.
Yeah, and that's one reason why here at Grand Wealth we're not looking to make tactical changes in portfolio allocations based on one frame's potential outcome. We're really committed to sticking to a target allocation, to sticking to that plan, rebalancing around it, and being able to see the full movie play out before we, cut short or leave early.
That's a great way to put it.
Well, this has been a great discussion, and I appreciate your time, Apollo. We are near the end of our hour together, so I just want to bring the conversation to a close. Thank you, those who were able to join. We have created a recording of this, and we'll be making that available to everyone to rewatch or share with others as they would like. If you have any questions that have come up or thoughts that you would like to discuss with anyone, please get in touch with your advisor. I know we have a couple questions that were submitted that we didn't get a chance to get to, and we will be following up with you to talk about those questions. Next time we get together, Apollo, will be in July, and we'll be looking forward to looking at second quarter results and seeing where things have taken us to the midpoint in the summer. So thank you again for joining us, Apollo, and everyone else who was able to join. Thank you, and we look forward to talking next time.
Bye. See you at the halftime report.
Yes.